So welcome back to another video. Hope everyone's been trading well. Today I'm going to go over a strategy that I use very often that allowed me to achieve over 2,500% this past week on AMC. I'll go over how I constructed the play via some option spreads, how I managed the position, and where I think AMC is going next. So let's get into it. On Wednesday, May 26th, when AMC began catching everyone's attention, I decided that I wanted to position myself to have upside exposure to AMC. FOMO got the best of me and I wanted to participate in this up move along with everyone else. But having been burned a lot in the past from chasing, I knew that I didn't want to pay a lot to participate in any potential further upside movement. So I decided that instead of just buying naked long calls, I would instead buy long calls and then sell additional further out of the money calls against those long calls to reduce the cost or debit of the position. In doing so, I'm creating what's called a ratio spread, where I'm long a closer option and short more out of the money options. In this case, I got long the 22 calls and got short 2 times the 30 calls. Each of these spreads cost 15 cents. And the reason why I was able to get the spread for so cheap was that the pump in AMC really inflated the prices of all options across the chain. When this happens, when the volatility is so pumped up, you can put on really wide spreads with large profit capture zones for really cheap. Just for illustration purposes, by comparison, note that had I bought the 22 call outright, it would have cost me $1.33. And if I had just bought the 22.30 call vertical, that would have cost me 74 cents. Compare those two strategies to the ratio, which was just a little over a dime. So you can really see that I've allowed myself the opportunity to play directionally for cheap. Now with this spread, because I'm short 2 times the 30 calls, I do have upside risk beyond $38 at expiration. And before expiration, my upside risk is actually a lot closer because of the remaining time and potential volatility premium built into the short options that would work against me. These are things that I kept in mind to constantly monitor in case I needed to adjust in case AMC ratcheted higher nonstop. Ideally, I wanted AMC to just meander higher to the $30 mark near the end of Friday, so that I could take the spread off for possibly around $4 or so, which would be about 50% of the max profit on the spread and would net about 2,500% gains. So that was the plan. Now, I was comfortable with the open-ended risk here in AMC simply because of the time left in the trade. Entering on Wednesday means there's only 2 days left for AMC to run really high and screw me over. Of course, I wouldn't let it run to infinity without adjustments, but ideally, I still want to start the trade without having to adjust shortly after. And the best way to avoid adjustments due to AMC running higher is to simply play the closest expiration so that the stock has less time to screw me over. So come Thursday at the open, AMC continued ramping higher, but paused a bit about an hour after the open, and at this point the ratios had already expanded in my favor to about 88 cents each, so I decided to take half off and lock in 480% gains right there. From 7 a.m. to 9 a.m. Pacific, I noticed that AMC was just chopping sideways, and I wasn't sure if AMC would continue higher, but I felt that if it did break out, it could run hard. I decided to take this opportunity to cap off the theoretically unlimited upside risk by turning the ratio into a 1-3-2 butterfly. That is, for every remaining ratio that I had, I sold 1 more of the 30 call and bought 2 of the 35 calls. This adjustment essentially cost 0 and left me with the 22, 30, 35, 1-3-2 unbalanced butterfly with a max loss of $200 per spread to the upside. Lo and behold, towards the end of Thursday, AMC did continue running higher, but because the upside risk was now capped, I wasn't too worried. So come Friday, AMC ripped hard to almost $37 at the open, which was actually beyond the outer wing of the 1-3-2 flies, which might seem bad at first, but because of the volatility expansion and every option was basically equally juiced up, the spread was still pretty profitable. Thank God we capped off the risk the prior day. All I needed at the time was for AMC to calm down, drift lower, and just come back down to the sweet spot at around $30 or $31, which happened. And when it did, I decided to take off the entire play for $388 per spread, which is about 2,500% gains. Again, for illustration purposes, taking a look at the historical quote for the 22 calls, the highest it traded before expiry was $14.75. Remember that on entry, I had gotten these for $1.33. If I had nailed exit at the highest value, the naked long call strategy would have resulted in a 1,000% gain. And if I had played the 22.30 call vertical, even if I had been able to close it out for a max value of $8, that would have resulted in a 971% gain. So you could see that the percentage gain potential with the ratios is a lot higher, as I was able to close them out for 2,500% gain off of the initial debit. Of course, the trade-off is that you really have to be aware of the unlimited upside risk, unless you cap that risk off. And if you do get the directional move that you want too early, you won't be able to capture as much profits as you could with the naked long option or the verticals because of the extra short options that you have that are further out of the money. When you're short extra options, your delta moves slower and can even go against you unless you're super close to expiration. Looking ahead, where do I see AMC headed next? My guess is that the pop is over and that we'll be headed lower over the next couple of weeks. Along that note, we do have put ratios for Friday, June 11th, with the long puts at 20 and the short puts at 12.50. So any pullback to $20 over the next week or two would be great. And if I'm wrong, it's not a big deal because the spreads were really cheap anyway. One of the most important things that we can do as traders is protect and preserve our capital. And ratio spreads offer a really great opportunity to do so because it could lower that initial debit drastically. Just be aware that with these spreads, the delta does move a lot slower compared to being outright long naked options. Also, the tail risk is there, so you should always try your best to cap off that risk whenever you can, whenever it makes sense, especially if you could do it for really cheap. All right, so that's it for today's video. I hope that helps and was somewhat educational and offered some insights into what you can do with options. All right, have a great weekend and good luck in the markets next week. Peace.